If we take ourselves back to March 2020, we had a really deep experience of market downturn. And thereafter, suddenly we experienced a strong rally up until June 2020. Very good V-shaped recovery coming through there. And thereafter, we suddenly see markets move almost jubilantly into 2021. And once again, faced with market headwinds in 2022, given Russia's invasion into Ukraine. We all wish we had a crystal ball that we could look into and know exactly what the future outcomes are going to be. But the truth is we don't. Investors have essentially been trying to seek out the returns, but were suddenly met with a downturn in March 2020. They were chasing the rally for the latter part of 2020 and then into 2021, and then suddenly needed to manage their exposure to risk once again in 2022 as market headwinds hit in. So it's been a really rough environment, and with growth asset exposure, it was very important to essentially remain invested, to dig yourself out of the hole that those very same growth assets had created. So despite the markets, it was of course important to remain exposed to those particular asset classes like equities, property, alternatives. But it's been tough, and it's really been tough because individuals from a risk perspective have essentially experienced that through a very real mechanism, and that being the return they receive on their retirement fund. It's a very tough thing to swallow when you're seeing this market performance emerge on the retirement fund you are essentially relying on for your future outcomes. The truth of the matter is any investor really needs to try and remain exposed to growth assets for as long as possible. And that is absolutely key, because what you're trying to do is try and generate inflation-beating returns. Over the short term and over the long term, it's very vital that you do so. The next key element is managing volatility. You don't really want extremely materially different outcomes from one month to the next. An example would be individuals retiring in close succession. You can imagine how different the outcome was for someone between February 2020 and March 2020 when they had the exact same investment discipline. Yet one individual, if they say had both R1 million invested, one left with R1 million in February 2020, while the other left with around 900,000 in a market-linked balance fund. A really tough pill to swallow when you've essentially done everything right. And it was nothing beyond what you could control essentially resulting in that. So a smooth bonus portfolio essentially stitches those two key vital needs together. Firstly, it takes growth assets and it grants exposure throughout the investment journey to ensure that you are always exposed to those inflation-beating asset classes. In addition, it manages volatility. And the way it does this is specifically through smoothing, but it also takes it a step further by outright providing a guarantee so that if the wheels well and truly come off, there's a minimal benefit that is available to the customer when they retire. What this really means is it is achieving this volatility reduction through smoothing, which is akin to a shock absorber on a car, smoothing out a bumpy road. And in addition, for the proverbial hole, which is far too big for the car to manage, we essentially have outright guarantees, securing outcomes for individuals. So we can certainly imagine that this is really important for an investor in terms of their retirement outcomes. We can just imagine for someone who was invested at the end of March 2020 in a market-linked balance fund, whether they would have liked to benefit from these extra layers of protection. You can essentially use an analogy to describe exactly how this has transpired. Imagine there are two investors, one in a market-linked balance fund and the other in a smooth bonus portfolio. And they're essentially traveling in vehicles that are represented by the journey from Johannesburg to Cape Town. The individual in the market-linked balance fund is effectively experiencing the traversal of the Karoo Koppies. It's a very tough journey. It's this sudden ups, sudden downs, and probably not the most optimal feeling along the way. What a smooth bonus portfolio, on the other hand, does is essentially allow a journey on the N1, a great smooth journey over time. And in addition, for any potholes that the car can't quite handle, you'd actually have outright guarantees to ensure at least a portion of your investment is guaranteed while traveling on the N1. So a great outcome nonetheless.